market analysis that will give you edge, and this really kind of matters.
Hello, guys, gals. Hello, how are you? We have 3 people online. Thank you for attending. Can you guys hear me okay? Hello, hello. Can you guys hear me okay? It's Brian here. Can you just, yeah, okay. Thank you, Areki. I appreciate that. All right, welcome to our analysis. I'm just checking up to make sure everything's working on our YouTube because I'm streaming live on YouTube now. And it looks like we are live. Yay. Okay, so let me get the screen open and we can start off the bat. Where am I? Where is my screen share? Oh, here we are. Okay. Let me know if you guys can see my screen okay. Just let me know if you can see the screen okay. And we shall begin. Awesome. Thank you. Thank you again. I hope I got Areki, or is that an L? Eric? L-L-L-A-R-I-K-L-I. Elraki. As I got your name right, let me know. All right. So you guys can see my screen. Hooray, hooray. Okay, let me just give me a second here and we shall get rolling. Okay, so just give me a minute. Sorry about all these technical changes here or whatnot. Okay, so you guys can see my screen. Awesome. So I'm going to bring up our notes and let you know what we're going to go through tonight. All right, so what we've got here is I just did a recent download of data from Dukas Copy. Hopefully you see my videos on that for the Forex platform, how to do it. And this is what we're going to cover. So I'm working off of a test account through Dukas Copy. So some of the data may not be real data. It's just simulated data. The other thing I want to make sure that we understand about tonight is we're not focusing on technical stuff. Like technical analysis, yes, but not technical on how these charts are generated. The other thing is I just want to have a general focus on the mechanics of the analysis, okay? So I'm doing this live tonight to go over how I do it from a human perspective. The automation one I'm about to show you is not built, but it can easily be built. And basically what we're going to do is just show you the sort of stuff I'm looking at. Now, first of all, it's really important that people understand that I do have daily analysis. I shouldn't say daily, but I'd say a few times a week I do analysis on Instagram. You'll notice here I have over 21,000 and pushing 22,000 posts live. And this is for Bloomberg analysis. I just put up a batch in the last hour. And if you want my opinion, this is the best place to go to learn about markets and just looking at the markets from an institutional point of view. And for that, you will learn a lot and nothing else, because a lot of this analysis is either present day, recent moves, or most important is forward looking. And that is the most critical point of the analysis when you look at data and making calls regarding markets. All right, so now that we've got that out of the way, let me just show you some of the videos that I have put up. I don't know if anybody is on my email list or on my social media, but I do have a new thing I just put up in the last week on patterns. Now, the patterns are very important now, and I'm relying on them more and more as I do this analysis. And basically, the analysis I have been using are patterns. So if you want to check out this video here titled Introducing Trading Patterns That Work 50 to 60% of the Time. It will show you how the patterns work. Next week, we'll go into more detail on how these patterns work. But tonight, I'm just going to show you a rough overview how I use the patterns as a way to remove a lot of the filtering out of bad trading signals, noise, and because that's what the patterns are really useful for. The type of patterns don't really matter. We're just using the patterns as a trading signal, and as I said, as another means to remove the noise in the market. All right, so I just want everybody to know we have two streams going at once. We have one on YouTube, and we also have one on Zoom, which is the delivery for the live webinar port. So I just got a comment on the YouTube. It says, "Hi, Brian. I've been following your podcast, starting to get interested in your material since trading Bitcoin last year. Would you happen to work with Dr. Eve Yeplish as well?" No, I don't work with Dr. Eve Yeplish, but I'll tell you his book is phenomenal. I should also mention that this has been brought up. The charts you're about to see are generated from Python, and I'm not here to push anything on people, but just so you know, I do have an educational course series. I'll start up promoting that in the next week, as well as I have a live trading analysis, which is basically all the charts I'm going to show you are going to be part of them. I'll be doing it hopefully every day. So hopefully I covered your question, Kev, or comment, but thanks for following. Okay, anybody else out there can more than get into a chat, and I'll address it as soon as I'm able to. But before proceed, so we have all the stuff introduced. So before I continue, I just want to make sure everybody understand where the data comes from. The data is coming from Dukas Copy through JForex. As I said here, up here, it's from a test account, okay? So a lot of the Forex data is pretty, I won't say accurate when it comes to being synced to the markets live, but the pricing is fairly close. And then we have the currencies, or the Forex, which is what Dukas Copy specializes in, but they're branching out into other areas such as commodities and equities, but they're not actual equities and commodities like the futures market or the options market. They are specific more to CFDs, and those CFDs have similar behavior to the underlying asset that you're trying to mimic, and that excuse me, is where we focus on the commodities and equities. Now, the type of assets we're dealing with in the currencies, we have 35 pairs. We're not dealing with any of the exotics because, as I said, we're just using a demo account. But once I go live, that's going to bump up the number of currencies I can watch live up to 60. And that will include things like the ruble, the lira, the Turkish lira, and I believe the China offshore yuan. Okay. And then we also have the commodity area, which I'll go through, as well as the equity, which is usually either a stock index from a particular country, like the US or, I don't know, Japan. And it also includes certain ETFs of specific sectors within the bigger geographic regions, like Europe overall, as well as Europe as well. So I got two comments on the chat. Just give me a second here. Which broker do I use? As I said, I'm using Dukas Copy, and let me know when you get a minute. Currently, I use Oanda Advanced Charting. Not sure if you're looking for comments on Oanda. I don't recommend Oanda because they've changed ownership in the last few years, and they have, and I've confirmed through other live customers of theirs where I actually have one former customer that's going through a lawsuit with them. So we'll just leave that about Oanda. But if you want to talk about brokers, we can address that at the end. And that's, again, El Raki. Got it. Yeah, we got it. All right, so back to the commentary here on the assets and the instruments. All right, so as I said, we've got an initial analysis that we're using for patterns, which will be used to filter out noise and perfect the timing of the charts. The next thing I'm going to show you is the Fibonacci and the technical analysis. And I'm going to do that in all of the asset classes, the commodity, equity, and currencies. Okay, so we're going to break that down. Also, at the end, if you want, I can continue depending upon how long this goes. And if people are still awake, I don't know. We can, go over forward-looking data that I have older scripts that I'm planning to use for U.S. Fed Reserve analysis. And that is really good for basically measuring where the U.S. economy is at and where the U.S. economy is going. I did an analysis last week on that. And just to give you an initial idea, the U.S. economy looks fairly strong still, which is quite, considering the negative news you've been getting in the markets. It's still relatively strong, surprisingly. And the one area of concern is the U.S. PMIs, which is the manufacturing index. It's been kind of shaky, as well as Eurostat. I can also cover all the major European Union members, all of the members there, and also segregate out using all types of forward-looking data in the sectors of each economy. So I have that ability, and I can show you that in the next, towards the end of this. So Kev asks, do you find any of those hyperwave or Elliott wave theories relevant to your algos? Just to answer Kev's question, let's just talk about hyperwave or Elliott wave. Things are cyclical. The problem I have with these Elliott waves, let's say, is that there are cycles in the market. And when it comes to the market Elliott waves, let's say, the hard part is to be able to gauge the perfect timing on when to go into the market, on top of when you want to get a measurement of that wave, how long, or the magnitude of that wave. That's the hard part. And that's why I've got these charts that you can use to sort of confirm the troughs in the market, as well as be able to gauge the timing of the entries as well as the exits as well. So I'm using my own set of indicators that seem to work really well. And the Fibonacci stuff seems to work really well, as well as the patterns work really well as well for timing. So, Elliott waves may work historically somewhat, but I just find I'm getting better mileage with patterns. So we'll show you that pretty well right now. So as I said here, all of these are for my own need, these notes for what directory I have to go into. As I said, we're going to be looking at commodities, equities, and currencies from Dukas copy. And then I'm going to show you the patterns first. I'm going to show you a few of them. As I said, we can look at the detail of them next week. But let me just show you the patterns. Now, the type of patterns I'm using are harmonic patterns. And there's usually 4 types of patterns in the market. So once I can find my proper folder here, just give me a second here. Right here. Okay, so I said, as you see here, I have all the different instruments here. So I'm going to start with commodity because it's a small amount of instruments. It's no more than 9 in the commodity space, and that's what I have access to through Dukas copy. Usually Bitcoin's the most popular one, so I'll start with that. So you can see here, I have all the different types of commodities. If it's Brent oil, Bitcoin against the US dollar, copper, a junk bond, which is important when the markets, there's no yield. So Dukas copy added the junk bond index as well, which is kind of nice. And then these bunch here are either gold or silver. And I also have a ranking using all the different other indicators to sort of speed up the analysis, but I do and will be giving access to all of the data once this membership gets promoted, and then, like I said, in the next week or so. So the first one, I'm gonna show you a pattern of the Bitcoin. So this is a typical Bitcoin pattern. This is a bullish Gartley. You can also get a bearish Gartley as well. There's 4 types of patterns. The more popular ones are a bats, Gartley, as well as there's a butterfly, and then there's one called the crab. at the end of the day, it doesn't really matter on the kind of pattern. All we really care about is that there's a pattern that's generated. And that pattern enables us to say, is it a bearish or a bullish? So meaning, do you go long or do you buy into that particular instrument? Or if it's bearish, do you go short or sell on the long term? Now, in terms of my analysis, I'm only focusing right now on end of day data, meaning daily charts, not intraday or 4 hour. The reason is because I have been analyzing stuff like crazy on a sub-minute level in Forex markets using Duca's copy, and I just find it very frustrating for the amount of negative, I'll just call it noise in the market that turn out to always be false positives. So when you get a signal and you took a percentage of the market on that signal, 75% of those signals are usually negative or just false, meaning they're no use. That's why we're using the patterns to sort of smooth all that stuff out and to be able to filter out the proper signals versus the negative ones. And again, when it comes back to the time frames, using the daily time frame is really good because it's very passive versus going into an intraday trading mode or day trading, which can be somewhat a difficult way to trade because the markets just move too fast and too random. Okay, another query from Kev. Thanks for all the wisdom you're providing. I can't find many with your experience. Oh, thanks, Kev. I appreciate that. As I said, anybody on here can comment either on the YouTube. I don't know how many. We got 5 people on the YouTube, and then we got up to 9 people on the Zoom stream, which is great. So anybody got comments, I'll definitely jump in when I can to address your comments. Okay, so going back to what I was saying, with the daily charts, I'm finding that is the best way to generate your trading signals. And then as you'll see, as I move into the charts, I'll start to look at either the 4 hour or the hourly charts, but nothing less than an hourly, because the type of analysis I'm looking at gets too noisy in the markets. And because of the size of, we'll call it the broker account, which is pretty well micro, meaning under, I don't know, 1,000 or even under 10 grand, unless you have a fairly large account to be able to generate. So Erecti is dropping off. Actually missed the meetup last week. Would like to chat later to be sure if you have a minute. Sure, yeah, I'll put up my email at the end of this so we can talk offline if you want. Yeah, so like I was saying though, where Bitcoin, the timing and the periods and the time frames that you're analyzing really depends upon the size of your account. So if your account is, let's say, under 10,000 or even 50,000, I think intraday trading is pretty tough to do unless you're willing to risk the account itself. You can do fairly well intraday, but it's just too noisy in the markets and it's just too random. Yeah, so that's just my view of it. If you're going to do day trading or overnight trading, it really depends upon your account size. And that is pretty important to understand. But again, my opinion may change in a month if I find the perfect quote unquote automated strategy for intraday. Okay, so instead of blabbing away, like I said, we have a bullish Gartley. We have the butterfly, the bat, and the crab. Now, I'm not going to get into the details of it. And at the end of the day, these type of patterns don't really matter. All we care is that we've got a pattern. And these specific ones that I'm looking at, as I said, the Brent oil, Bitcoin USD, copper, junk bond, and the silver and gold have signals. Everything else we don't really care about. So like I said, we've got this particular bullish Gartley. And what this chart represents is the ability on the x-axis, this is the price. Now you can see the data is kind of off, but here are the dates of when these signals get generated. The thing to understand is when you look at these up and downs, we want to make sure we only get the large price moves and nothing. We don't care about these little intraday ones. And to be able to gauge these is very hard in the markets. With what I have here, it seems to work really well. And when I did my analysis months ago, what threw off any of my signals was these little moves. And sometimes you can go into a range bound. Sometimes you may go into a sudden upswing or a downswing. And that can be driven by a number of things, if it's news in the market or anything. So this is really how to smooth out those false positive or noise in the markets. Because all we really care about over the last year, which this represents, actually I think it's 90, no, maybe I think it's the last year. And these price moves, the signals themselves are only reflective of the largest price moves over the last year or so. So I want people to understand that. Okay, so like I said, there's 4 types of signals, patterns, and I just mentioned them. So I'm able to use these. So out of that, I have a way now, and hopefully, you know, if I do have videos on this on my YouTube channel. Just give me a second here. I want to show you what we're doing here. So we're right now in the patterns for commodity. So I can show you all the other patterns as well for the other ones. So we have commodity, a currency. Each one of these have their own sets of patterns, okay? And when I'm looking at my charts or looking at my ranking that I'm just about to shoot, all I care about are looking at the ones where patterns are generated, okay? That's really important to understand that. So these are the only ones I focus on, nothing else. I don't care about the other ones because this is generating those signals, and that's what I'm looking for. Now, another thing that's very important to understand is the longs versus the shorts. The strategy and the analysis I'm going to be doing, because I'm going to be starting and using a micro account, I'm only caring about longs. And the reason I don't care about shorts is because shorts are very difficult to trade. So at the beginning, when I go proceed with the live trading, I'm going to be focusing only on longs because we have enough things to worry about when it comes to just overall analyzing the market. So once you throw in the shorting, it just complicates the analysis. So I don't really care about these bearish signals or bearish patterns. All I care about are the bullish ones. Now, we know we're going most likely into a what we'll call a risk-off market regime, meaning that there's going to be more down market activity versus up market activity. And that will mean there's going to be more, obviously, bearish signals than bullish signals. So as a result, I will still be looking for what they call the green shoots in the markets, the longs and the bullish signals, and they're always there. I've looked at everything here, and if the markets go into what you can call it defensive mode, you'll note that when I show you the currencies as well as the indexes, which is really the equity, there's 2 defense plays going on, which gives you opportunity on the long side, meaning what I'm about to show you is you'll see on the indexes and the equity market, everybody's moving into Japan. That's a defensive trade in the equity. On the currency side, I'm going to show you that the best performing pair are anything to do with the Swedish krona or krona. I'm not Swedish, so I can't remember which currency it is, but it is a Swedish currency, and that defensive play is #1 for the currency market. So let me just show you now the commodity performance. So we've looked at some of the patterns, just generally the signaling. And what I'm going to show you now is the Fibonacci signals and the ranking of the currencies, or sorry, of the commodities. So in here, I've got subdirectories for the commodity, and I'm just going to pull it up here. Okay, so here I have these ranking spreadsheets. So I'm going to pull up this now, just so everybody knows, I use LibreOffice, not Microsoft Office, just in case you kind of get confused. Let me just pull up the proper file here. Right here, this is the right one. So you can see here that the file This file, again, using Python, is generated. It was generated today at 4:31 p.m. my time. So this is the ranking for the commodities from Dukas copy. So basically, as I said, we have 8 assets in the commodity asset class. I'm just going to sort this file. Now, again, I can fully automate this. I just haven't built it out yet. So I'm just going to sort this. And the results is the one I want. That's a little calculation that I use to give an overall performance. Now, this has been like this for a number of weeks, and I'm just going to break it down for everybody. Okay, so this is the results overall. Now, I'm looking at this for the last year, and you can see, obviously, Bitcoin will be the highest performing historically over the last year. Now, when you look at everything's now going kind of defensive, we would expect the U.S. Treasury, which is the TLT, to be up there as a commodity, because people may not think a commodity is just, let's say, agriculture and metals. That's not true, because commodities also include the financial markets, which are Treasury or fixed income. That's considered in the professionals, institutional space. Financials is also a commodity, like Treasury or Eurodollar would be considered a commodity. So number 2 would be U.S. Treasury. Now, U.S. Treasury is a defensive play, but the thing is, when you go to the Bloomberg news, you'll notice that there is money moving into U.S. Treasury, but the premium on the 10-year is starting to hit 3%. And that's where I think where all hell will break loose in the markets, is when the U.S. Treasury interest for a 10-year hits 3%, and it's on the way up again. And that is usually either driven through the news with the trade wars with China. And what China will now retaliate is they can also use, because they have so much of the U.S. debt, they can sell it off and then spook the U.S. economy as well as the markets in the U.S. So as a result, you'll get some decent performance on the premium of the 10-year Treasury. That's why it's number 2. And the interesting thing I find is that the copper space is another one that's been doing fairly well. Now, let me just break down the columns here, okay? These guys here. So what I'm referring to in the ranking is the results of these various columns. So the first column I have is the slope. That's just the slope of the price line for the last year. And that's the slope of it. So you can imagine with the performance of Bitcoin, it's very steep. And then when you compare the Treasury, it's getting up there as well. And when it gets steeper on the price line, that basically means that the steeper it is, the higher potential profit you'll have. I can show you that in J4 itself. And then again, copper is up there as well. And I only really, gonna be honest, all I really care about are the top 3 instruments of each asset class. And if I was a betting guy, usually for my testing, when you look at portfolio analysis, which is another important element, is that when you deploy capital, if it's $100 a day or $1,000 a day, you want to get maximum performance for your least amount of risk that you want to put on. So as a result, you want to make sure that you are deploying into the right instrument to get maximum return for the next day, just on average, or for the next week, or whatever period you're wanting to deploy capital on. So obviously, U.S. Treasury is pretty safe because it's the U.S. government and it's issued by the U.S. government, meaning, yeah, it's pretty safe. Copper should be safe as well. But when it comes to Bitcoin itself, I question Bitcoin because the volatile moves that Bitcoin has. So unless you're willing to put on that risk for the potential of the return, but at the same time, you're going to have a higher probability of losing money, you may want to skip over Bitcoin. And that's what I'm seeing a lot of people are doing, because that's what one of the reasons why the price is dropping, I find. And that's, again, from the institutional level. So these are really important things to understand. But for copper itself, it's up there because it's still what they call a base metal in manufacturing. And when we get to the US economy analysis using the Fed, the Federal Reserve, you'll see the overall manufacturing. So you can use this CFD, future contract, whatever, in copper as a base metal to measure performance on how the US economy will perform, which obviously impacts the markets, or sorry, stocks, as well as other future contracts. So that's why copper's still fairly strong, but I think you'll soon see copper drop off from here, and you'll start to see gold move up. And that's just, again, one of those defensive plays as the markets confirm to slow down and become more negative. Because right now, there's not a lot of clarity in the markets because of the trade wars and the news around that is driving that unpredictable nature when it comes to the markets. I'm going to shut up now. Has anybody got any questions on the rankings? Okay, so I'm going to continue here. So we have the slope. This one's important as well because this is the moving averages. And from playing with this stuff, at any technical analysis, I don't care who you talk to, the moving averages is a perfect way to confirm your pricing forecast because you just use a simple cross on your fast moving and slow moving averages, and you can use that to determine your confirmation on your theory. So essentially what we have here, this is a moving average on the long of the daily moves. So the higher this column is, meaning more crosses of moving averages, the better confirmed performance you should get for that asset. So you can see here that Bitcoin is going to have a lot more pricing move. That's just due to the volatility of Bitcoin. You won't get as many moving average crosses in Treasury because, well, it's liquid, but it's just not as volatile. So it's a lot smoother. And then you get into the copper as well, which is, again, pretty high. But when you start to look at these guys, let's say gas and silver, that's just due to, again, volatility. Gas, because of the season, we're coming off of the winter season, which you would have gotten great performance going into the winter and fall season. And silver, from what I read today, again, confirmed theory, is that silver is outperforming gold because this is the poor man's gold. Poor man's gold on top of silver is used more also in manufacturing versus gold. So oddly, you're getting more crosses of moving averages in silver. So just to give you a reason why these two are fairly high. So again, this is the top three to look at if you wanted to deploy capital. Now, the last column are the positive returns. I should mention this before I proceed. In my notes here, I just want to talk about stats overall. Are they useful? They are and they're not. Stats is okay to confirm theories, and that's about it. The problem with stats is that they have give all kinds of information, but it's historical. And because it's historical, it's hard to gauge and use for forward moving or forward guidance. So I still use stats, but the only thing I really use stats for is this one other column here. I'll show you back. So this particular column, number of positives, that's from the stats world. That's basically meaning if you took the last 500 trading days and the returns, how many of them will be positive? How many of them will be negative? And the more positive, obviously, is the better. But what's the point of having more positive versus negative? I'll show you that again in the Federal Reserve or U.S. econometrics, because that's important for that kind of information. But that's all I really use currently stats for. And then, of course, we talked about the results. So if you were to start to look at the better performing assets, namely Bitcoin, Treasury, and copper, I'm going to show you some of the charts for this. So everybody asked about Bitcoin and cryptocurrency. And as I said, cryptocurrency is really good for its own world, but I'm only looking at the data coming in from Dukas copy. I'm sure if you know coin market caps, there's hundreds of exchanges out there and hundreds and probably thousands of cryptocurrencies as well. So that's a different world. We're not focused on that world in this session. We're just focused more on Bitcoin and Bitcoin only. And usually Bitcoin's the metric for the overall cryptocurrency world anyways. But what I'm going to show you now, if I go back to my notes, is, and I'm just going to touch on this, is Fibonacci retracement levels as well as technical analysis. So let me go back into the commodity, and I'll go back to all of these currencies and equity in the next little bit. But I just want to break it all down for commodities because everyone's going to want to probably on this call or whatever be more interested in Bitcoin and Bitcoin only. So let me show you the overall commodity for this. So we've already looked at this spreadsheet, the ranking of the assets. So I want to show you some of the charts right now. Let me just go into my just give me a second here. Just load up my, okay, commodity. So I just want to make sure I'm in my Fibonacci. Okay, so we're in the right folder. Just give me a second here. There's so much data that's generated, but that's why I built the spreadsheets for the ranking. Okay, so first one we want to look at are Bitcoin. So I'm going to now break it down into the technical analysis as well as the Fibonacci or the Fibonacci retracement. What I'm about to show you, I used to laugh off for many years on this stuff, like technical analysis and all this other stuff. I thought it was a bunch of BS. But when I started playing with analysis using quantitative and even machine learning, this stuff is still the best performing and has still the best forecasting, I'm finding, because this is what the professionals use. And there's two reasons. It's because it's easy to understand, and it's just, this is what the professional trading world uses, and it seems to work. And I'm going to show you why. So the first thing I want to show you are the trend lines for the performance of Bitcoin. So this is a general thing that we know about. The overall performance is down. Now here, I just want to, before I forget here, you'll see here it's underscore 1 hour, underscore 4 hour, and underscore daily. So I provide 3 different time frames for each instrument. So in my case, I want to look at the end of day data of the trend line for Bitcoin. And I'm using 2 trend lines, which is to mimic support and resistance. And basically here you can gauge the overall performance over the last 2 years. So you can see it's come up and it's come back down. It's still on a long-term trending up, which we know is not true. If I was to look at the corresponding 4 hour, you can see now it's flattened out or pointing down. If I want to go even further on an hourly level, I can do that as well. And that's where the down trend is pretty evident here. So this is really important. And again, when you look at this data, you look at these charts, as I always like to say, the numbers don't lie. So no matter who you talk to, it's this type of data that confirms that theory. So those are the trend lines of Bitcoin and US dollar on all 3 time frames of daily, 4 hour, and hourly. So let me show you these stats, okay? So there is this PDF that I can generate. This is a PDF document. So here on Bitcoin daily moves, you can see that these are the percentage of moves, like a normalized distribution. And you can see these are the percent daily moves for Bitcoin over the last, I think it's 500 trading days, which is just over 2 years. But you can see here, it's moved a lot, and it is volatile, but at the same time, it is fairly stable, surprisingly. So that's what these stats generate. And if anybody like a math nerd, I have all the detailed stats, descriptive stats in this chart. So for this time period, I'm able to show the ones that I'm using are the number of positive and negative moves for that time period. And obviously it's at a 500, I believe. So the more positive, obviously that means I should have more up momentum versus down momentum. But I also can calculate things like kurtosis, the average or the mean, the skewness, as well as the standard deviation of 1, 2, and 3. Now, for those that don't know, these are the equivalent of Bollinger Bands. So if you're using, let's say, standard deviation 1, those are normal moves. When you start to use standard deviation 2, those moves basically mean that those are within normal range. And that's kind of like hitting, that's the same measurement as what a Bollinger Band would be. And then, of course, you have standard deviation 3, which are the extreme moves, which are now moving into the outlier. So you can gauge the overall volatility of this particular instrument by looking at these stats, which is helpful. But at the end of the day, that doesn't help you out because it's historical, but doesn't mean what it's going to be doing moving forward. So that's the stats. And again, I have the same equivalent of daily, hourly, daily, 4 hour, and hourly. Okay. So there's that. How do I buy your futures course? Mike, I'll address that in a minute. I have a subscription series I'm going to be introducing in the next couple of days, actually. If you want to join my email list, I'll be announcing it probably tomorrow. And it's going to be a really good deal. It'll be a bunch of courses as well as my other stuff as well. So we'll talk about that and in a little bit if you can hang on. Okay. Okay. So again, with the daily moves, that's what we're looking at. So what I showed you is the trend line, the stats, and these are the unique things that have the ability to generate. This one's kind of cool because these are overall signals that I can use. So you can see here for the daily moves on Bitcoin, over this timeline, we have lots of buying signals, but we have very little buying signals or even selling signals. But if I needed to go into the 4 hour signals, I could do that as well, like here. Okay, just as an example. So you can see I have the buy in green and red and as selling, that's evenly spread out. So from my point of view, I'm not going to get a lot of good performance out of this because it's just kind of going into a range bound mode. So from a capital deployment, I would not want to be wanting to put money onto Bitcoin. And I'll explain that why, because there's better opportunities out there in the markets, and we'll find that in the equity asset class. So I'm going to show you that in a minute. So those are the signals. Now, I have mentioned in the past about moving averages. The moving averages are very, very powerful. This is where you can confirm your theory. This kind of like I'll call it off green line is the overall 200-day moving average. And these two are either 20 or 50-day moving average. So these crosses right here confirm what you're thinking. Yes. Are we going to get a potential up move? And if that happens, you can use that as a confirmation, as a potential, and I'm going to underline potential market opportunity for entries. Okay. Really important to understand that. And that's the beauty of moving averages, and specifically on the crosses of the 20 and 50-day moving average. So when you see your 200-day moving average higher than the 20 or 50-day moving average, that's telling you that the markets are either undervalued or underperforming. But this is just one layer of confirmation that you can use to determine if you want to go into the market or into this particular asset like Bitcoin. Okay. I wouldn't do it, but there's going to be people out there that feel lucky and will go into the market with Bitcoin. But as I showed you earlier, you have so much downward movement. It's kind of scary. For me, I wouldn't want to touch it. But, as I said, there's going to be people wanting to do it. But I think there's just better market opportunities out there. So these are the moving averages, okay? And I'll show you a few more. This one's really good. If you're familiar with RSI, like relative strength indicator, let me show you the other one, the daily move. Okay, so this again is Bitcoin, and I'm going to show you the Fibonacci retracement for the daily chart on Bitcoin. So you can see here, these are your Fibonacci levels, okay? I'm not going to get into educating on Fibonacci. This is just so, I didn't realize how useful this was. But Fibonacci can be used in a number of ways. When it comes to valuing your price, or as I talked about in the patterns, all of those patterns are derived from the exact same Fibonacci levels as well to generate your patterns as well. And as I said, if you want to look it up, just look up, and we'll go into it next week if you're interested, to talk about harmonic patterns. And that's the thing I'd look up is harmonic patterns. And as you learn this stuff, you'll realize that also is derived from Fibonacci levels as well. So in this case, we're using it for pricing valuation. And this right here between the orange and purple lines is where you want to trade, because this is your golden zone. And once your price moves into that zone, that is another potential market entry. So another question from Mike. I'm mainly looking how to automate my future strategy. Need to learn to code the strategy in Java. I signed up for IB today, trading coding course, something you saw. Yeah, I have something for you. We'll talk about it at the end if you don't mind, Mike, because I purposely said, as in my notes, I'm trying to stay away from as much technology and keeping the nerdy stuff out, because not everybody on here is going to be a coder, but we can definitely address that afterwards. Just remind me if you don't mind. Okay, cool. I'm trying to run through this as fast as possible because I want to show how I'm doing this and how you can interpret these charts. Okay, so going back to this, as I said here in this blue dotted box, this is your golden zone that you want to be in for pricing. And you'll be, and remember, this is historically over the last 2 years on the valuation of Bitcoin. So this type of chart is very, very good. Now, if you want to trade, I guess, on the 4 hour, you could look at this one, Fibonacci, for the 4 hour, and you can see it's just touching on the golden zone right here. And that's telling you we're now entering historically on a 4 hour chart, historically that the pricing is coming down, and that's a good thing. But as I said, because we have other charts to confirm, this price may be driven down farther and farther down. So why would you go into what you call a falling knife when the pricing is going down? And that's the whole point of the patterns, is to derive that quote unquote bottoming process. And that's why I use patterns. So that's the Fibonacci overall. Okay, so I've shown you the trend line for the two lines, the stats, as well as the signals and the moving average and the Fibonacci. And those are the only Fibonacci, technical stuff that I use. So going back to my notes here, what we've talked about is the Fibonacci retracement and the technical analysis. And one more thing, it's really important that people get this. And this is how a lot of traders use, I should say institutional traders. I've heard this so many times on Bloomberg TV that a lot of the traders use this exact methodology for their own needs. The only difference is now I've automated this. But one of the things about this particular chart, the Fibonacci, let me just pull up the Fibonacci here on the daily as I had earlier. Or actually, I'll do the hourly, sorry, or the 4 hour. Okay, so again, we're going to look at Bitcoin. Okay, maybe I might be able to show you a better example in another chart, but let's just say we decide we want to go out and short Bitcoin. Okay, so we know now on the 4 hour that we are entering into what we call our golden zone. So we could have used this Fibonacci level here as a potential market entry, or better yet, we can use this line, the orange line, as a entry into the market of Bitcoin, because we're entering into that zone. So if I'm trading Bitcoin on a 4 hourly basis, I can use this particular example as a shorting opportunity of Bitcoin. I could say, okay, once that price does drop below that orange line, I'm going to enter into the market and short only. And then what you could do are a number of things. If you want even a better opportunity, you could say, well, I'm going to wait it out until this closing price drops below this purple line. So we can use the Fibonacci retracement as ways to target our pricing and our entries into the market. And that's what a lot of these professionals do. It just depends upon the chart, and it depends upon their time frame they want to trade, okay? And then once you start to move into this particular level, you can use that as a potential of an exit, okay? So there's numerous ways to play this. And one of the things I have in my strategy is for exits, I'm going to be automating the way to automate a virtual stop loss, so I can have my system say, get out of the market once you hit that stop loss virtually, and not signaling back to the broker. Because as you may have known me, I don't trust the broker. I don't care what you say, because the broker and the market making, blah, blah, blah. Once they know your signal back to the broker, they know when you want to get out, and they can manipulate that trading opportunity. So as an example, as I said earlier, Areki was asking about Owanda. As I said, we have a lawsuit from somebody with Owanda, and what happened to them was numerous times they'd use something like MetaTrader, put in their stop losses automatically. Owanda knew when that stop loss, the price still runs up, and for whatever reason, we'll call it quote unquote technical issue, with Owanda, they'll cut off your price, kick you out of the trade that you had, even though your stop loss may have been higher, and then you won't get the profit that you should be going, and they kick you out prematurely. And they do that as a way to cheat you, basically. It's not market making, and they do that pretty well. I can't say they do it all the time, but from what I've heard and confirmed many times, this is happening throughout a lot of these corrupt brokers, because you're signaling back to the broker and you're giving them your stop loss. And because you're doing that, they can have ways to monkey around with your profit potential. And another example is trailing stops. So if you have a system that will automatically track your trailing stop, you're able to ride those profits without having your stop loss kick you out of the trade and that profit opportunity. So you can have this rolling, we'll call it stop loss, or it's better known as a trailing stop. And if you automate that in your strategy, it's just a really good way to maximize your trades. So that's what a lot of people do. And that's what a lot of the professionals do as well. But you want to keep that outside of the signaling back to the broker, because once your broker knows what you're intending to do, they may, I'm not saying they will, but they may screw you. It just depends on the broker. As a FYI. Okay, so we've looked, as I said, we've looked at all the different technicals on the trend line stats, moving averages as well. So let me just go back to my notes, see if we got everything covered off. Okay, so we've shown you all of the potential technical analysis on commodity. So I'm going to show you the equity space. So we're going to look at the indices as well as the ETF. So I'm not going to get into all the equities. I'm just going to look at the top performing. Okay, so as I said, we're going to get out of the commodity area, and we're now going to move into the indices, which is or equity, which is on the top performers. So I'm going to load up my spreadsheet, and let me just show you the, I'm looking for my kind. Okay, so we are looking for Microsoft XLS, which is this one right here. Okay, so I'm using LibreOffice, not Microsoft Office Excel. Okay, so these are all of the, everything's the same. Everything's the same as before in the commodity. Nothing's different. The only difference is just different instruments. So I'm going to sort this one again, and again, I can automate it. It's a very simple process, but logically, it kind of makes sense. The columns are the same. Everything's the same. And in our case, we're going to be sorting column C, the results. So let me just sort this. Column C, descending. Okay. So here, everything's now been sorted. So what are our top performing indexes? Now, these are all of the different ones we have. So we have 30, we'll just say 30 different indexes or ETFs. So they range from France to Spain. We have ones that focus on biotechnology, technology, real estate, you name it, it's in here. Brazil, whatnot. But we don't care about those. What we care about are the top performing. So I don't know if you guys have watched my analysis from Thursday's data. The Japanese index was the top performing index. Okay. Now, in this case, I just did it today, and now we have the top 30 of the US markets. Now, this is a ETF from Dow Jones. It's basically the Dow Jones top 30. It's an ETF, or sorry, it's an index. So if you were to put money into this over the next day or so, you get top performance. And again, we're looking at the slope, number of moving averages over a certain period of time, and the number of positive returns historically, okay? So in our case, and this is if it was me, and I didn't want to play in the world of Bitcoin or cryptocurrency to get the next top performance, the top indexes I'd be interested in are here, the US top 30, the Japanese index. Technology is still relatively doing well, but you got to also remember, because of the Facebook stuff going on, that's actually dragging down this index. But these are your top three, are the US top 30, Japanese, US technologies, and in there you will find the German one, which is pretty well dropped off. Now, this particular one, the Japanese, as I said earlier, is a defensive play, okay? That's where the markets are, what I call the hot capital, the hot money. That's where a lot of the hot money is going into. This one seems to oscillate between the Japanese and the top 30 for the US. And this is where I put a good chunk of my money, because these are your top performers. I'm going to talk about Forex in a minute in terms of performance. And the reason I like equity and indices, and you can play these through ETFs, the reason I like these is highly liquid. You don't need any leverage really, and you're going to get really good performance. So this one I've added the LSE because it's actually the LSE group, the London Stock Exchange group, which would include other indices as well, or stock exchanges they've got in their portfolio. So you can see that they're doing well. And the odd thing is, I'm finding that the British, Great Britain, the index out of Great Britain is starting to come about. And who knows, mate, that could be driven by the negotiations with Europe over the Brexit, and it's stabilizing. So maybe there's getting better outlook and better performance. So this is why I like ranking this, because you're going to start to see the little surprises coming out of nowhere. That this, if we bought into this, we may get some decent performance. But these are your top two right now. And that's where I deploy my capital, if you ask me, if I was, as I said, a betting guy. All right, so let's check out those charts. So does anybody have any questions so far? Comments? I'm always in the comments. This is the reason why I do this, is to learn if this is helpful for you all, y'all. I'm not from the States, obviously, but if anyone's got any questions, just jump in, like throw in a comment on the YouTube or the Zoom if you want. Okay, so let's just for kicks, just check out Britain, because Britain's an interesting one. I haven't seen Britain at all, but obviously we're talking about the FTSE, the FTSE, the Financial Times Stock Exchange, or that index. That's pretty well what we're talking about. So if I go into our equity folder here and look at these particular charts here, the first thing I want to look for, do I have any patterns generated for Britain? So let me check to make sure. So come under my equity here. Yes, we have two patterns generated for Britain. Now, it's not one, but it's two. So that could be yelling at me. This could be a buying opportunity. So now I've not looked at this. So I'm just going to give you my interpretation of Britain, the index, the stock index, to see what's going on here. All right, so let's look at the daily, see what's going on. So you can see, oh, wow, I haven't seen this before. It's got an up move. And again, that's over the last few years. And you can see here it's bounced off of that support. Yeah, I'm always getting these two lines confused, but we'll call it the support line. It's bouncing off, and there's some performance happening here. Now, let's check out the signaling on the daily chart. What's it generating? Okay, so we got one here. And not saying I would do it, but it's something I'd put on a watch list to say I'd be very interested to see what's happening with the British index here. And again, I'm buying this through Dukas copy. So we can look at our averages. So this is, again, really important. This is how we can really use this to interpret what's going on in the British. Okay, so you can see here the 200-day is starting to move up, but our short-term 20 and 50-day are higher than the moving average. So that means we're now starting to get some performance. You can see here in this cross, that's a selling opportunity. And you can see the price line in blue, it did drop off. But you can see here that the 50 and the 20 are about to cross. And the spread between the two is starting to tighten. As the spread between the 20 and 50-day start to tighten, that, my friends, is what we may consider a potential market entry. So if we were to automate this fully and generate an entry signal, that would be a really good one to get into, because it seems that we have the up momentum. Plus, we also are seeing that here it crossed, and guess what happened? It did go up. You see this cross, the price did spike up from roughly 7,300 to just under 7,600. So if we see this cross, we may get that same type of performance. And we can use all the other charts to indicate that trend or the momentum of that. So this is looking pretty good. All right, so the other one we want to make sure is our pricing historically in our golden zone, and it's not. You can clearly see that it's overpriced. So this is where we go, okay, if it's overpriced, it's overvalued, do we want to enter in if the potential of that cross on that moving average doesn't happen? And at the same time, we don't have the momentum. So it looks good. The question is it worth going into right now? Because it's just not, it's overvalued. Again, that's, historically since 2016 in December, okay? So always keep that in mind, that the valuation is really, really important to remember. And again, I can gauge that performance with all of the European stuff I mentioned. I think I mentioned it, but this is how powerful the charts that I've got. Let me just show you my notes again. So later on, we're going to look at the U.S. Federal Reserve economic or macroeconomics. And again, it's forward-looking, but we also have the ability to look at the European stats. And as long as the UK are part of the Eurozone, we have access to the Eurostats from the Eurostats department of the out of the Eurozone. So we have the ability to see what's going on in UK and be able to measure what not only overall the overall economy of the UK, but we can see which sectors are red hot. And I'll give you a hint, it's construction. And I'll be able to show you that in a minute. Okay, so that's what's going on in UK right now. Looks good, but it's overvalued. And again, I can also, if I want to trade intraday, I can then look at the 4-hour hourly to sort of like go in and out, or maybe build a scalping type of strategy or whatnot. But this is, again, daily, looking at this stuff daily, okay? So that is really good to know about the moving averages, but it's overvalued. And again, if we can look at the statistics as well, blah, blah, blah. So that is Britain. But let's check out the top two, which were We said Japan and the top 30 in the US. So let me just make sure. Okay, so I'm going to show you this one, the US top 30 and the Japanese. But I'm more interested in the Japanese because I'm starting to find with all the negative returns that we've been getting in the markets in the last week that there's going to be more capital going into the Japanese index, like the Nikkei or the Topics out of Tokyo, because that's where the hot capital is going to go. And when I say hot capital, it's really important to understand hot capital is pension fund money. Pension funds are mandated to get a return for all of the organizations that pension fund is managing. Same thing when it comes to the large asset managers like BlackRock, Vanguard for their ETF performance. They're mandated to get return. And that is what I'm referring to hot capital. And when you follow that hot capital, that is where you're going to get your best performance. And when you understand that, you will get maximum opportunity or maximum profit potential. And that's why I built it this way. So let's check out the Japanese one of the Japanese index. So just loading up the charts here. So again, we have hourly, 4 hour, or daily. Okay, so I'm going to just look at the trends of what's happening in the daily. Let me just close out all the British stuff. Okay, so we have the Japanese. You can see it's been having a fairly decent upswing here, but we're starting to enter into a range bound. And I think that is driven by 1 minute, the markets are down, and then all that money goes into the US. And if the markets don't look good for the US, they move it into the Japanese markets. And that's what's going on here. Okay. So that's what I think is going on there. But when I look at the Fibonacci levels, the valuation, again, it's overvalued. Now, there's a number of ways you can play this. Do you think that this right here will be a potential breakout like here? That we don't know, but that's where we look at things like the patterns to look for what are the patterns telling us. And I'm going to be building out some even more technical analysis stuff like flags, pennants, and wedges, which can even break down the momentum on that daily price move. So this is looking good, but doesn't mean I would put money into it wholeheartedly because of why? It's overvalued. And if we're not going to get that performance moving out and we're going to have our capital deployed into this type of index, we're just not going to get the performance we're looking for. And this is the challenge of the overall trading. So depending upon your goal, you could either look for undervalued assets like Bitcoin, but will you get the performance moving forward? We don't know, but that's why we built this, or I built this stuff like this. But for now, I can tell you when the US markets come off, people will put money into the Japanese. And this is where right now, this is where the performance is somewhat. I mean, but remember, the markets are going down overall, and we're not getting the overall positive momentum we've had for, 7 years now, since 2010, really. So it's going to get more challenging to trade and get performance. But with this kind of data and the charts, you'll be able to analyze everything and figure it all out. So right now, I think this is where the money's going in and alternating between this and the top 30. And this is oscillating between the two on the capital or the performance of the top indexes out there and the overall markets and the different areas you can put money into. Okay, so let's continue analyzing this. So we know the Japanese indexes, or this particular one, is overvalued. So the question is, do I deploy capital today into it? Will I get performance tomorrow or moving out? We don't know. But that's the one that's giving us the best performance right now. And again, we can get that really better confirmation like right here, okay? This is a classic confirmation of entry right there. Because you can see here, this cross right here crossed. What happened? Went from roughly 19,000 all the way up to just over 20,000. And that's over 100 days. So that's over the last three months. So we had a roughly close to a 10% move in 3 months because we could have invested into the markets. So knowing that, you know, we know here's an entry right here, right there is a potential entry opportunity, because that's what the moving averages are telling us, because we have a definite cross. And if we know that the US markets start to dip, that cross right here means the hot money is moving into Japan. And I think that's why we're getting this cross. And we can verify that by looking at the top 30 as well. So we've looked at the signals, we've looked at the moving averages, we looked at the Fibonacci. We know we have a pattern generator for this. So the next one to look at is the top 30 for the US, okay? So we can see there is an oscillation happening between the Japanese and the US top 30 for best performance in the equity space. So let's check out the top 30. So I'm going to move down here for the top 30. Again, that's a Dow Jones average. So let's check out this. So you can see here we have up momentum. We're bouncing around on the resistance. I always get these two confused. I'm sorry about that. I just don't put a lot of emphasis on my support and resistance. But statistics I don't really care about. The signals is the one I'm looking for. But you can see here, right here, that is buy. That's what's been happening for the last roughly, I'm going to say 75 days. Now, regarding the charts, I will be building better charts using a tool or a library called Chart Director. This is open source charting from Matplotlib, and it's pretty good, but I can build much better charts, and that's what I'm going to be doing to give you the exact date on when this happened or when the momentum started. But overall, we can see that we've got buy for the last roughly 75 days, I'm going to say. Okay, so that's good. But what are our moving averages saying? Now, remember I talked about the spread between the 50 and the 20-day. Here we have a cross. We knew we were going to get that pricing momentum up, which we did. And we can see here, as these two start to tighten, we may get another cross. That could be actually, here's a buying signal because we have a cross here. But if these cross, like the red and crosses, it goes higher than the green, that's a selling signal. So that means the markets will be confirmed to turn. And again, if you compare that to the Japanese, that's a good way to measure when the markets will turn. And we can use those as a typical, not entirely exclusively for a buying selling signal, but just another layer we can use for that market entry or exit. That's why I love the moving averages. And I know these will be overvalued, which they are because of the Fibonacci says so. So again, depending upon how you want to do it, the potential's there to move into this, but this could turn and go negative, just depending upon what drives it, which is the news, trade war news and all that kind of fun stuff. But we can also confirm it because we have data we can use for forward-looking guidance. So I just want to show you all these different charts on how to gauge these day by day. And as I said, the overall rankings can oscillate every day, but you may get the occasional one like this British one that may just come out of nowhere and something you may want to watch down the line and put that on a watch list, let's say. Okay, so I'm going to stop there on the indices or the equity, and then I'm going to show you the Forex stuff. Anybody got any questions so far or comments so far? Because I'm now going to move into looking at the Forex. Okay, okay, so what I'm going to do is I'm going to move into the Forex space. I'm going to keep this open. And now the Forex is interesting because let me just pull up the proper spreadsheet that I want, the overall ranking one. Just give me a second here. Okay, I'm going to sort by kind. We are going to load up this guy right here. Okay, so I got some general comments on currencies. A number of things that are affecting the currencies market right now are the trade wars. There's commentary about the overall US dollar has been dropping for the last year. That's number one. Number two that I'm getting in my news notifications is that China is trying to really push hard to get the Chinese yuan as the global currency now, the metric now, instead of the US dollar. The Chinese are really pushing hard to get the Chinese yuan as the global currency benchmark. What's happening is right now, the US dollar is dropping, the yuan is rising, and what I understand the Chinese are they're trying to move, when they say the petrodollar for oil is the US dollar, they're really trying to push hard to get the yuan to be the new fiat or petrodollars to be the one. And the Chinese government is really pushing hard on that. So to understand the yuan and how the yuan works, there's two components of the yuan in China. There's the domestic yuan, which only Chinese citizens can trade. And of course, China, the government has also Taiwan and Hong Kong under its influence. When the Chinese government took over Hong Kong, they left Hong Kong as an independent state, free enterprise, and it's performed fairly well over the last few years. So the Chinese yuan, internally or domestically in China, is very good currency for the Chinese citizens that can trade. They also have the ability to trade between Hong Kong and China, because this is what they call a two-way train of currency trades and all other kinds of assets between China, the mainland China, and Hong Kong, on top of Chinese and foreign, I think more Hong Kong residents can trade on that daily capped trading volume that the Chinese government has. And of course, that influences the Chinese yuan. So for us, the citizens of outside of Hong Kong and China, the only thing we can either trade is the offshore yuan, which I have access to through Dukas Copy, and the other way to trade China as a proxy on the indices is through the Hong Kong index as well. So that's the overall how the Chinese markets work on the currencies. So I don't have access to the Chinese yuan here because they consider it an exotic, but I do have access to the overall Hong Kong dollar here as the Euro Hong Kong. So overall, I can measure the performance of all the currencies. There's 35 currencies I have access to right now on a demo account, and the pricing's fairly accurate to the real markets. So let me just do this data sort here. And I'm sorting on column F, descending. Hooray. Okay. So this is really important to understand. The markets overall of Forex is not that great. And that's because of the trade wars. So what's happening is if there's currency traders in there in the hot money field, the only places they're basically hiding out because there's virtually no performance. So where they're hiding out is in the Swiss Corona. I always get these two, but the Swedish currency, not the Swiss. The Swiss, I'm not seeing any performance, but the Swedish one is doing okay. But out of all the currencies, it's the best performing. So we have the Euro Swedish, the US dollar Swedish, and then oddly the British and the Canadian, which is a strange combination. But these are your best performing currency pairs. So when you look at the slopes are really low. Okay, now this is also factoring in, I'm not including leverage. And when you hear brokers say, oh, well, we're going to give you 100 times leverage, which is very high risk to blow out your account fairly quickly. they want you to do that because they want you to lose. So they'll give you this exorbitant amount of leverage, and they're hoping that you blow out your account so they can make money off you. And when you see these type of slopes, they're really low. So if you were to throw in leverage, you're getting into higher risk or putting on higher risk to still get very, very substandard performance. And if you're not trading these currency pairs, these top three, you're not going to get the performance. So if you're stuck on the majors like the Euro US dollar or the Euro Swiss franc or the British US dollar and the really low performance, again, measured by the slope of the price line, you're just not going to get the performance. Yet they'll tell you, hey, take more leverage to get the performance of these currency pairs, yet you're still not getting the performance as compared to the indexes or even Bitcoin itself. That's why I'm right now saying trade the index. You're just going to get much, much higher performance, much higher returns for much, much, much lower risk. That's why I'm showing you this. The currency pairs are important, but unfortunately, I just don't think you're getting the performance out of Forex overall. But we're still going to look at the charts. So when you look at the slopes for all of these are really low when you don't factor in leverage. The moving averages look good with the crosses on the moving average, but we'll look at, let's say, these two, and then we'll look at, we'll look at these two currency pairs. So let me load up the Euro Swedish kroner. My apologies if you're Swedish and I got your currency mixed up. My apologies. Okay, so we're looking at the Euro Swedish. Okay, so let's see what the overall performance. It looks pretty good. We're hitting maximum here. And again, I'm figuring because it's Swedish, because it's out of Scandinavia, that's where the performance is going for currency traders, not anywhere else. I would have said the Japanese yen, and I think the yen's not getting the performance they should. And historically is because, again, of trade wars with China. And I don't know, Mr. Unpredictable Trump has mentioned Japan. And because of that, I'm figuring they may get hit as well. So I'm figuring institutional traders or currency traders are figuring the same thing. So they don't want to touch the Japanese yen. So they're not putting capital into it, but yet they'll put capital into a currency that really doesn't affect the trade wars world in the world or the view of Trump. And Sweden's one of them where Sweden never comes up. So I'm thinking that's why the Swedish currency is doing better out of all of them, oddly enough. But as you can see in the chart, this is where it looks. See, we have here over the last 100 days buying signals. We also can probably look at our Fibonacci levels, but it's overpriced. So that's where the institutions are putting their capital in this pair, and it's overvalued. And what else can we look at? The moving averages, the important one. See here, we had a cross right here. Oh, sorry, right here, there was a cross. Last 75 days, and that performance has been pretty good. So that's pretty good if you're willing to put on the leverage, and it works for you. And you put on the trading call, the entry, and you lever up. I don't know, times 10, 100, whatever you want. And if you were to do that and you are on that right side of the trade, you're going to get really good performance if you get it right. And that's a pretty high risk move, but if you get it in here, you've done well because you've gone up from, let's say, just over 9.8 to 10.2, which is a pretty nice move, and it's still going up. So you can see why that's doing well. So let's look at the other one, which is the US dollar Swedish. So we'll load that puppy up. And you're probably going to get the same story as the Euro Swedish. SEK, yeah, I'm sure it's similar. Oh, oddly enough, it's going down. Who knew? But let me just see what's going on here. You can see recently it's been some buying signals. I wouldn't be touching this at all. It's kind of a high risk because there's just too many. And even amount of spread of buy versus selling. So it's a high risk currency pair. I wouldn't want to trade if I was to tie up my capital. But again, the moving averages tell you that. And you can see there's a cross, a little bit of performance, which tells you that is an intraday play. That is, you're going to be using the hourly and 4-hour charts to trade it if you wanted to do that. So that's generally that. Let me just see the valuation of the overall. So nice. Again, this, you can see here, it's not in our golden zone, but it's under that. So if you were to long it and play it on an intraday level, maybe even scalp it on an intraday, the valuation allows you to do it because it's right. It's undervalued, which is good. So that may be something worthy to investigate if you're willing to take on that risk and get probably some decent intraday performance, as well as it doesn't cost you a lot. And that's pretty well the currencies. I'm not going to look at any of the other ones. They're just not worth looking at, if you ask me, based upon the risk. So anybody got any questions or comments so far? So the next one, if not, we can look at the overall forward-looking data. So I'm going to start focusing on the US Federal Reserve data and the Euro after that. And the reason I'm moving into this is because we looked at the top 30 of the US markets, and we want to know, well, what's worthy of trading if you wanted to do direct stocks. You could use this type of analysis to figure out what sectors look good. These charts here that I'm about to show you were built originally for my equity arbitrage strategy, which can work, but it's just not worth, the predictability is not worth pursuing on it from a trading perspective. But this particular data I'm about to show is really worthwhile because it's forward looking. And as you can tell, we looked at Sweden, we looked at Britain, and we don't know how it looks in the future. So let's check out what the US says. So part of my data that I've put together, I'm just going to load up an entirely different set of data here. And again, this is built about a few years ago. So I'm just going to load up those set of charts. And these are, the code's quite old, but it works. And it's been pretty consistent, surprisingly, with this type of analysis. And again, this is what the professionals do. They look at only forward-looking data. They kind of look at present-day data as well as historical data, but a lot of the emphasis is put on overall forward-looking data. And these are the metrics that they use, the indicators that they use for forward performance. Now, I need to stress here, what I'm about to show you takes about 2 minutes to run. And this one document gives me the entire overall perspective of what's going to happen in the US markets. So to compile this set of data would probably take you who knows how many hours if you were to do it as a human. That's why I love automated trading like crazy, because I can get in a one document a quick snapshot on what's happening. And again, you're not going to get this through the news. You're not going to get this even on Bloomberg. And this is one quick snapshot on what to look for. So these are the indicators that you can use forward looking. What's gonna happen. So the first one we're looking at is what they call industrial production mining. And here you get your price line all the way back to in this case, 1919, when the Federal Reserve started. And you can see overall what's been going on for the US economy since that time. And you can see it's been going up and up and up. And then here in 2009, it drops off, but it starts to climb again. But here's the important stuff, all this little data here. Now, we've talked about the stats, the number of positive moves and negative moves for everything here is measured in quarters. So it's measured in 30 days. Or 30 days or 31 days, depending upon the month and whatever the US Fed does. But overall, You can see here we got 2 positive moves in the last 3 months, which is good. But we can generally get our averages for the 3 month, 6 month, and 12 month for that trend. And then we can get the performance change between the previous periods. So we can generally get an idea of the momentum of this particular price line here. If I zoom it in, you won't see it. But again, I do give the data. So if you want to do your own analysis, you can do that. And we can talk about how I provide this data. But overall, this is the production mining. That has gone up because since Trump has come to power and he's putting the mining, US mining back on the map, as opposed to Obama didn't care about mining in the US. So here is the GDP, gross domestic market, right here. This is really good. It shows how strong the market's up because we've had 4 positive moves over the last 4 quarters, which is basically a year. That's good. Here we have industrial production index. Now, this is moving forward. This is moving forward over the next 30 days. So where this data comes from, and again, this is really either from the St. Louis Fed, which gets its data from the PMI, I believe, and this is forward-looking. So this is basically an association of manufacturers saying, this is how we feel over the next 30 days, and we're going to gauge our production over the next 30 days based upon how we feel, how the market is in terms of putting in orders for their materials to produce products. So you can see here, it's fairly shaky. 2 moves, but 1 negative. And it's the negative that you need to worry about. So it's now going to go into that choppy mode. Now, I may, in future reports, expand this to, let's say, 5 moves, 5 quarters, 5 months worth of data instead of 3, just to get a better gauge. But when you start to get more into these choppy 2 positives or 1 positive or 1 positive and 2 negatives, and it gets really confusing. You don't know where it's going to go. It just shows you that's what these manufacturers in this case don't feel that strong about the economy, which means, well, it may start to slow down. But you can see on the long term, it did do fairly well. But right here, where it started to drop off is when the U.S. economy started to more offshore a lot of their production. And that's why we are entering in these trade wars with China, because the U.S. population wanted a president to enact that. So here's another important one. The U.S. Michigan consumer sentiment. This is how the overall general consumers feel. And you can see here, historically, it's done fairly well up to the late 90s. It is coming back since the 2009 period, which is pretty good. And again, we can use these positive and negative moves as a gauge in how things look over the short term. But this is the area of concern. When you start to get 2 negative months of consumer sentiment, that's not a good thing. So the consumers don't feel strong on their spending, which obviously affects the outlook of the U.S. economy. So this is why this sort of data is really important to gauge, to see how the overall U.S. economy is doing, which again impacts the U.S. markets and everything else involved the U.S. markets. So here is another really, really good one. These are now what we call the housing units building permits. These are for housing. So for housing, this is really good too, because a big driver in the U.S. economy is obviously homes being built. They're not affected by offshoring. So again, this is used as a forward indicator. And again, we have here 2 negative months. So moving forward, they don't feel strong about the housing market. And you can see historically, there's that big drop off in 2008-9 as it was slowly coming back. And again, because I do this historically all the way back to 1960, it gives you a reflection of the overall economy up as far back as 1960. And this is really important to understand this, because this is how we measure the overall business cycles. And this is where I have difficulty telling people, yes, you can use business cycles as a measurement on when you go defensive, or do you put money into cyclicals in the stock market area? And when are those classic terms like here, and here, these peaks and troughs? And the problem is you don't know when to time it, and you don't know the magnitude. And that's what I addressed one of the previous questions on Elliott waves. Elliott waves kind of work, but this is the reason why Elliott waves don't work. Because yes, you do have the waves of the overall economy, but again, as I said, you don't know if you were just to bet on the housing market itself, you don't know when to perfectly time it. And even if you did, you don't know how far up that move will be or how far down that move will be. Because here you can see it maybe, I don't know, let's say 5 years or 3 years. But here on the next upswing, it could be over 12, 13 years. So that magnitude is different. And that's affected by really outsourcing and not offshoring of manufacturing and how it affects the overall consumer in the US economy. So this is really important. That's why I put a lot of emphasis on this, to get a general idea of what's happening in the markets in the US economy. So again, we need to be concerned about these 2 negative months. Okay. Now, the other area that I like are manufacturing of, keyword here is durable goods, hard goods. Okay. These are planes, these are cars, these are other industries that feed into aero and cars, because those are the big old school legacy industries that drive the US economies. And guess what? These industries I'm speaking of will be heavily affected by trade wars being started up by Trump. So again, this is another really powerful chart. You can see again those trends since early 90s to now, and you can see the cycles of the business economy. But we get this, I can't explain it, this weird anomaly on this big pop here. But overall, you can see we are historically due for a downturn in the manufacturing space. Even if Trump wasn't to announce trade wars, historically, we're due for a correction and for this to come down. For how far, we don't know, but it's coming and we don't know. But again, this is the confusing part, is we have 2 positive months, but 1 negative month. But it's going into this choppy mode. And it's, if you were to go back to this type of trend, you probably would have gotten 3 positive moves. But it's a good indicator to say, yo, we're coming up for a correction of some kind. I just noticed on the YouTube that I got 3 likes for this stream. I appreciate that. And as I said, if you got any questions or comments so far on anything I'm showing, any point, just jump in and comment away, because I have here my chat open for both the Zoom and the YouTube. Okay, so moving ahead, we now have another factor that I think is really important to understand about the US economy, is we have defense capital goods, excluding aircraft. When the markets go into a defensive mode, meaning it's entering or in recession, or I don't even want to say depression, usually strong defensive stocks that do well are defense stocks, meaning military, because if you historically, again, look at the economy in the US versus the presidents, when you go far back as to, let's say, Reagan, Republican president, the markets declined. The US was in recessionary conditions. So what did he do? He started to ramp up military defense mode, and it was against big bad Russia. And that's in the 80s. Along comes Clinton. Then it's no longer defense. The economy booms, and that's a Democratic president. Then comes in Bush, and it's now Iraq. It's the Mideast, it's the big terrorists. And again, the military defense complex, those stocks do well in that time period. And then when you look at Obama, same thing. And now we got Trump. So we know that the military is going to start doing well. And that's where the defensives come in, that type of stocks, if it's utilities, military, all the health-related or pharmaceutical do well in these kind of periods. And now we have Trump. Guess what? He's now going into a more wartime, we'll call it, scenario, and you're going to start to see the military and defense stocks do really well. And you can see that here in the outlook on this type of chart, where we only have one positive and two negative. So things are turning. Classically, when will they turn? We don't know, but it's starting to show it's slowing down. Now, here's another one, non-farm payroll employment. This is wage inflation. This is what's killing off the U.S. economy. Wage inflation is not keeping up with overall inflation. And more people are going into poverty. There's less and less wealth being created for the middle class and the poor. And as a result, this is the big challenge the U.S. economy is facing. And the payroll is going up, which is good, but it does not reflect overall the wage inflation. But this metric, the non-farm payroll, is used as a wage inflation gauge. Again, that's forward looking, but we can see it is going up, which is good, but it's not going up fast enough. Unemployment, again, it's been positive for the last number of months. You can see here in the charts, they say it's historical lows, but you know, when you look at the mid 50s, but overall in the last 30 years is definitely in its lowest period. So again, that's good. Then we have industrial production. Again, mixed report here, number of positives and negatives. And again, it just flattens out since China and the trade and offshoring started back in, I'll say, probably early 2000s. Again, industrial production, again, durable, but this time consumer product. And again, mixed report. And these are the top employers, and it's a mixed look. And that's obviously not a good thing. Then we get into industrial business equipment. Same thing. It's a mixed report based upon a number of positives and number of negative outlook. Okay, so these are really important. And you can also use these when, let's say, for example, if you were to use what sectors are really good to enter into in terms of stocks or sector via an ETF, let's say. So let's say the durable good consumer is down, but business production looks good. You know, well, you want to be in the sector of the business production because it's strong. Again, we got a phone number here. I'd love to have a chat. Okay, I got your contact, dude. I'm going to put that offline because we don't want people to see that. All right. Okay, so we got the difference between consumer and production. Okay, really important. Now, we have unemployment. It's starting to look mixed here. Okay, you can see number of positives and number of negatives. It's not a steady down or up, and it's just, we don't know which way it's going to go. And that's pretty well all of the forward looking. Oh, thanks, Kev. My gold is gold. Thank you. I appreciate that. Okay, so there is that. Okay, that's the U.S. economy forward looking only. Okay, so we got one more to look at. Anybody got any comments or questions? I got any comments, Ocha. Really appreciate and all the likes and stuff. I really do appreciate it. Anybody else got any more comments or questions so far what I've shown? You can see all the charts that I've shown when it comes to the patterns and the technical analysis, it's all mixed. But if you are looking at specifically for the US, we can use what I just showed you on the Federal Reserve stuff, how the economy looks, and we can confirm it. And we could try to get a much better gauge on how the US economy will perform. So now we're going to drill down into the Eurozone, including the UK, because we talked about Britain and the UK index, as well as Sweden itself. So I'll look at a few of them. for the Eurozone. So for Europe, all this data comes from these spreadsheets that you can easily download from Eurostats. In my case, I'm just automating it. I'm just processing it, and I'm making charts out of it. Again, if you were to automate this, you're going to save yourself a lot of time. If you do this as a human, you're going to spend hours generating this. And all this data comes out monthly. And again, it's very similar to the US Fed, but this time we are looking at the overall European market for all the members. On top of, we are looking at each sector. And the important thing is it's very similar to the US Fed, but we're doing it sector by sector. So this one's a little more confusing, but I'm going to show you just the overall spreadsheet you can download from Eurostats. And again, you can download this yourself, but the difference is I'm just taking it to the next level of how the Eurozone works. So what we have here is we have everything by country. Okay, now again, this is Europe. We know about the Brexit. We know about Britain will formally pretty well leave in March 2019, but UK is still part of Europe, the European zone. So we can still use Europe as part of that analysis. So just as an example, we have new upcoming members, countries that are going to be part of the Eurozone. So they are going to be ME, Montenegro, Macedonia, Serbia, and Turkey. They are being considered to be new members in the Eurozone. But currently, what we have here is the countries in the Eurozone are broken down by this code of by country. So let me just show you a couple examples. This is really important to know. Actually, I got a better document. This is an older document that I've downloaded. It's kind of current, not current. Let me just set this guy up, get the kind up. So we want a Word document. This one right here. So this set of documents that I've shown you is what we call the European Economic Sentiment Index, or ESI, European Sentiment Indicator. These are the countries we can break it down by. We can look at overall Europe, because from a trading perspective, Europe and the euro, the currency, is considered one zone. Okay, so we have the top three would be US, Japan, and Euro, which is part of the Eurozone. So we can further break down the Eurozone by country. And then we also have Euro area. And the Euro area is interesting because we have the Eurozone and the Euro area. The Euro area would also include countries that have their own currency. So UK would be considered part of that, Sweden, Norway, and oddly enough, Switzerland is not part of the Euro area. So we're not including Switzerland, but we include these countries that I got listed here. So we've got by code BE being Belgium, BG, Bulgaria, and so on. And obviously we're just going to look at some of them. We're going to take a look at the big powerhouse, Germany, and I'll show you France, just as they're not doing so well, as a contradiction to Germany. And then we'll show you the other ones that we were questioning is the UK, as well as the other one, which was Sweden. So we'll take a look at those countries, but we can get it broken up into further by Eurozone. So Kevin's asked, I think Macron's wife being 15 years a senior is Europe's most concerning tragedy. Somewhat, yeah. Yeah, I will agree. France is not doing well, but I'll give Macron is trying to improve it. Okay, so now let's take a look at the Euro chart. So as I said, I'm going to show you Germany, which is DE. Germany, where are you? I know it's here. Okay, so Germany is DE. So my charts, anything that has DE right here, are the particular charts that we can look at. Okay, so we have, just so you understand on each country, DE building, DE consumer, DE overall ESI for the economy as a whole, industrial, retail, and services. So this is how it's broken up by these codes. Okay, so I can show you the building, consumer, and these are by sector. So building, consumer, industrial, retail, and services. And this is a really good snapshot, both broken down by an overall sector within that country. And as I said, we're only going to look at the ones of interest for us, which would be Germany, France, UK, and Sweden. So let's check them out. So let's check out the overall performance of the ESI. So you can see here, historically in 2011, that's when it hit its peak. And it's starting to come off now on the overall economy of Germany, according to this ESI report. But don't let that scare you, because it's going to be strong and there's going to be the weak sectors. So building looks good. Overall, if you just do a rough eyeball, it looks strong, as you can see here. Okay. So we can also see the weak points in the German economy as well. So it's not as strong in consumer. How's the industrial looking? And again, we can use this as a general gauge on how Germany is producing and how it's producing with the overall economy. But you can see here, if I was to zoom in there, you can see it's tailing off. And that is broken down, I believe, by month. And again, I have the raw numbers as well in that spreadsheet I just showed you in the ESI. And you can easily download this. The only difference is I'm just pushing it out one step further to chart it. So let's check out the retail of Germany. You can see not looking good. So that's not a good sign, obviously. And that means the economy is not doing well. And guess what? Services dropping off in Germany. So things are definitely slowing down outside of the building area of Germany. So we know the strengths, we know the weaknesses, or the weak and strong sectors of Germany. Now, I want to show you France to see how France is doing as compared to Germany, as just an example. So here's the overall ESI. It's coming back, but you think, well, how's the French area? Very strong in building. How's the consumer looking in France? Fairly strong. Industrial, it's up. So, but you could see here, this is the interesting part of the retail of France. It's coming back, and that would mean that is that the domestic consumer popping or increasing the retail, or is it tourism, let's say, just as an example? I don't know. But how's France services doing? It's dropped off a little bit, but you go, maybe France is doing better than Germany. We don't know, but it's something worthy to look at. And again, guess what? We've got all that data available on that French, where's that? French index. So we have here France right here. So we can use all this data I'm showing you for France on showing you that it looks strong, but why isn't the French stock index or stock market doing well? So that's something I don't know, but it looks strong, but I don't know. It's just forward looking. France looks strong. Where can we talk about coding? Give me another 5 minutes, Mike, and we'll be able to do that. I know. Thank you very much for your patience. Okay, so France we looked at. Let me just wrap up here on UK and Sweden. So we talked about the UK. So let's check out how the UK looks. The building has come off quite a bit, as you can see here. The consumer has tailed off a bit. The overall British economy, come on, is dropping off there, as you can see. The industrial, it's still strong here. And retail dropping off, as well as the services. Okay, so it's dropped off. So UK is not as strong as you'd like. How's Sweden doing? Again, we can look at the building. It's dropping off. Consumer, it's strong again. Overall economy, the ESI, it's coming back. The industrial, coming back a little bit. And the retail, coming back but flattening. And again, services is dropping off. So there you go. That's the European zone. So Mike, let's get to all the nerdy stuff. before I get into the nerd talk and the geek stuff, anybody got any questions on the charts and the analysis so far, including everything I just did? Because all the notes I've got covered. I've talked about everything I wanted to cover. So we've done now the Euro stats. We've done the U.S. Federal Reserve stuff. We've looked at the overall equity. And that, again, all this data I'm talking about from here on equity, the commodity, as well as the currencies, all from Dukas copied that data. Okay, so anybody get questions or comments so far? No? Okay, so Mike had a question about courses. So let me just get into that. Thanks for putting up with that so far. That's 2 hours of stuff. Okay, so let's get into all my regular stuff. All right, so if you go to my website here, I'm changing everything up quite a bit. If you go to my blog here, I'm going to put the link in. I'm just switching over to a new email service. Now I just put in my chat. If you go to quantlabs.net, quantlabs.net/blog, what you'll have here is there's two choices. You got download a PDF and courses. I'm not sure on people's on their level of technical building out their own algorithms. It's not easy, but I try to make it easy as possible. But I do have this course that's available that I'm charging $200. I'm going to be raising it to $250 eventually, but it's been doing pretty well. So I thought I'll just keep it at this price. But what this will walk you through is essentially this will walk you through. Oh, looks like that promotion's off, but I'll show you how to get it in a minute. So this course, what it does, it enables you to learn about Python, how to use Python to build out your basic charts that I've shown you. I've shown you how to use it with a database if you wanted, how to use it with a free data. So I have that. Okay, that's $200. That's just to get anybody interested. That's where I point people that want to learn. Now, there's two new things. Well, it's not new, but I'm kind of, we'll call it relaunching. Now, if you press this download PDF, I've got two books, and they're fairly quick reads. The first one is how you can use a spreadsheet and build basic, if you're not a programmer, how to build out basic trading with a spreadsheet. Not recommend. I'd rather use Python. That's probably what I'd tell people to get into. So if you fill out all your details, you get two PDFs, one for the spreadsheet stuff and just an overall benefits of why I do automated trading and all that. So let me just put out some fake data stuff and I'll show you what happens. So hopefully this will go through. So it'll say your report's on the way. It'll email it to you. But here, you'll be able to get that course that I mentioned earlier about learning how to trade for the $200 course on Python. Just go press get full access now. That'll take you to the course. So now this is specific for guys like Mike. Hope Mike's listening. Okay, so if you go back to the top here, back to my blog, here I have something called courses. Now, this is the same similar idea. You fill in your details, you get intro to the course. If you go through this methodology to get onto my email list, I'll be introducing, or if you're currently on my email, now the other easy way to do it is if you just go to the bottom here, you'll get a yellow pop-up, and I'll take you to one of these places for learning how to do the course stuff. So let me just go back to my blog here. And what I'm going to, this is something I'm getting kind of happy about or proud of. Okay, so I've got two services I'm going to be having. I've got courses. So if you enter and get your name on that email list, I'm going to be introducing a new promotion. I've had a service called Quant Elite, and that included 3 courses. It included that Python introduction course. I've got another course for futures. which enables you to understand at a more advanced level how to tie in a database with interactive brokers, let's say. So there's that course on how to show you how to use the interactive brokers trader workstation platform. So I've got a course on that. Then I have a third course that Mike's been asking about, the futures and options course. That is a course that will show you how to build out futures and options at a fairly advanced programming level, both for what do you call options and futures using fundamental analysis. So I didn't get into any of that stuff at all tonight. So all these courses are part of a service I'm kind of relaunching called my Quant Elite. And what that will do is it will give you either 3-month or a year access to everything that I put out, that I currently have, and what I'm going to put out during that, let's say 3 months or 1 year. And it's going to go up in price. When you look at a lot of other courses, they're going to be probably $500-800 just for one course, but I got 3 up now. So there's that. And as I said, Mike, if you go into the blog and under, as I said, quantlabs.net/blog, go into courses and put your name and all this to get onto an email list. I will have available all the stuff for futures and options that you've been asked. So he came back and says it's not fundamental. Well, the fundamental is using both the futures and options. But here's the nice part that you're asking. What I just showed you tonight can be used for any asset class for any period, any time period. And that's going to be part of my quant analysis. But I'm just going to provide the charts. That's for non-technical people. And that's just for pure analysis purposes. Kev So says, just graduated university and looked into programming. I'll highly consider your course. Yeah, so as I was saying for both, I guess, Kev and Mike, the not fundamental, yes, but I'm going to tell you something about the futures and options markets. Those drive the prices. Tonight, if you look at the Bloomberg News and you'll see the U.S. futures says this, I can guarantee you that data, U.S. futures, let's say, will drive what happens in the trading session for the U.S. markets. So that's why it's critical to have the understanding of the fundamental for both futures and options. You don't have to trade them, just watch them. You can get a general gauge on what will happen in the markets in the next trading session. And you can apply that to the Asian or even the European markets as well. So there's that. So let's say you wanted to understand quantitative or technical. Well, what I just showed tonight is all the technical. So I'm using Dukas Copy. And with Dukas Copy, I'm able to generate all the charts that I've shown. And I'm going to have a brand new course. It's sort of, I've already got it, but I'm going to put it in one package where you'll be able to get how to use Dukas Copy, how to use the programming, how to integrate it with a database, how to push it into Python and then extend it with all the Python stuff they got, because I really like Python. But you were asking about Java. JForex from Dukas Copy is only, I'll show you some examples here. Okay, so I'm going to load up JForex. This is JForex right here. So in here are the strategies. So I like Dukas Copy because it's a clean broker. It doesn't give you all those premature stuff with the market making. So that's why I like Dukas Copy. So Mike says, I made a mathematical technical strategy for futures and Thinkorswim. Is there any way I'd be able to learn from you how to make that strategy automatic for me and IB? Yeah, I would. Because as I said, I got a specific course on, I just can't remember where I've got my marketing. That's about a year ago. But I do have that specific course on how to use interactive brokers with the trader workstation, the TWS. So there's 3 ways you can interface with TWS. It's via Java, C++, or Visual Basic, let's say, or even Excel. The ways I would recommend to interface with interactive brokers is using Java. That's what you've been asking about. So I do have lots of examples of how to use that. And it's pretty powerful. It's pretty involved, but I cover things like message queuing and working with the actual TWS software itself. So I show you how to download historical data. I've got a module that shows you how to work with current data and how to use the TWS and how to push orders into TWS to push your market orders out. So I show that. That's pretty involved, but I do have a whole dedicated course on that, and it mostly works with Java. I would recommend Java as well. C++ can be a lot more involved. Unless you're using the protocol of Fix, it's not much faster. If you use the TWS on its own, either with Java or C++, I don't think there's much difference in speed. The only time you get extra speed, we'll call it, is using the Fix protocol with the C++. And to be honest, if you're going to go down that path, I hope you have a very large account, like let's say 100,000 plus. If you don't, then just stick with a simpler TWS option. And if we'll call you a medium knowledge programmer, Java's your better option. So I'm hoping that helps you out, Mike. If you got any specific questions, let me know. So with that, what I'm planning to do over the next few days, actually, is to introduce a new promotion. I've got two options. I've got two subscription terms that I'm going to have. Currently, I've not been pushing that option, but starting maybe tomorrow in the next few days, you'll be able to get access to all the stuff, and I'm going to charge $700 US, and that's going to give you 4 months instead of 3 months. So you're going to get a free extra month. And what's going to happen is I've got the 3-month option where you're going to get 4 months, or if you wanted to do the full 12 months, it's going to be $2,800, but a lot of people don't have that kind of capital, which is fine. That's why I have the 3-month, and which is really the 4-month for the price of the 3-month. And you, like I said, you're going to get 3 courses in that. Plus, over the next 3 months, and I purposely did this, is I'm going to have some live boot camps on Saturdays. I am going to have a boot camp for the Python course I just introduced, as well as some new ones. So Kev came back. How much money would one need to have to begin with efficient algo trading? Okay, that's a good question, Kev. It depends upon your goal. If you're trying to live off of trading, you should have a fairly large account. Again, 50K and up. Most people don't have that. I get that. But the nice thing with the kind of stuff I've shown you is you have the ability to control your own destiny. And as long as you understand the fundamentals of how the algorithms can be generated, you got a huge future for yourself. Trading fees can be killer. Okay. Okay. Let me continue with your previous question. So if you're starting with a small account, $1,000, $5,000, don't focus on what you need. What you should focus on is focus on learning the craft of strategy building with automation if you have a small account. And I wouldn't even dare to even start with a large account because you most likely will lose that capital if you don't know what you're doing. So you want to focus building those skills and getting confident with it. Okay, so you can start with small, $1,000, even smaller, depending upon the broker you want to go with. So that's what I'd focus on if you're new to all of this or even new to automated trading. Okay, that's my suggestion. So, but it really depends on your goals. So I don't know your precise goals, but if you're starting from a micro account, I would only focus on just that, a small account, and really focus on the skills and developing the skills. So hopefully that can help you out there. Now, Kev asked, I sometimes hear trading fees can be a killer. No, not really. depending upon, again, the broker. If you, depending upon where you live, if you're using interactive brokers, there's lots of options you have available. You probably have to spend a bit of money to get started, meaning you'll have to pay maybe a data feed. Depends upon what kind of things you want to trade. But the commission fees, for example, Dukas Copy is very low if you are living outside of the US. So you can join Dukas Copy. If you're only stuck with interactive brokers, the commission fees are $1 each round trip. So it's $2 for that. So hopefully I'll answer that question. So Mike comes, where can I buy that course that just mentioned, the one about programming? As I said, Mike, what you want to do, because this is all brand new now. If you go to my website here, let me see if I can put it in. I'm not signed into YouTube, but if you want to do it, as I said, you are quantlabs.net/blog. Okay. In there, oops. Okay. So you go to quantlabs.net/blog. What you do is go into the little indicator that says courses, and you'll see 9 keys to crypto and Forex trading automatically. Sign up there, and I'm going to start pushing out all the offers of what I mentioned to get you into that service. Okay. And that's how you'll get access. Okay. That's the best way. Okay. For you, Mike. Kev says, I got lucky with Bitcoin. Yeah, I know a lot of people that got very lucky with Bitcoin. Bitcoin was an anomaly last year. I don't think you'll ever get anything like that again. That was once in a lifetime. If you made good money with it, awesome. And I'm happy for you, believe me. Hope you got out too. I thought you had a lot of info today. Thanks so much. No problem, Kev. I hope it really helps you out. And just the kind of charts that I'm using now, they seem to work. I have better analysis techniques now that work better. I've tried trading on we'll call it sub 5 minutes. And unless, as I said earlier, unless you have a larger trading account, it's very difficult to trade on we'll call it, I won't say high frequency, but it's not nearly what you can call high frequency trading as we know it. But it's a very difficult form of trading. Now, with all the techniques that I've shown you, with the patterns, they may work with high frequency, but I really believe if you're trading under an hour, you're going to get a lot of those false positives, and that's a lot of noise to filter out. But I haven't really tested the patterns to see if they have the capability to filter out those false positives, because the difficulty lies in that it's just the markets are so random and they move so fast, and to be honest, you will lose money very fast if you trade on that time frame. And it's something, and personally, it scares me. Even though what you read, it's hard to trade, to be honest. So I don't know if that helps you out. So I don't know if anyone else got any questions. I hope I answered everybody's questions, including you, Mike and Kev. And I think we have also Ireki online. So if you guys got any questions, if you got any questions on anything on trading or life or whatever, I'll do my best to help you out, because I've been going now for 2.25 hours. I like doing these. I'm going to do another one next week. I'm going to focus on the mechanics of the patterns. And Mike says he's got one more thing. Go ahead, Mike. Go ahead, Mike. Can I hire you to build the code for me? Aha. Mike has a very simple question. Mike, that's a good question. As I said earlier, there's 2 services I'm going to have. I'm going to have a programming one for people that want to learn how to do this and learn how to get the code, own the code, control the code from a programming standpoint. That's a very difficult achievement for a lot of people. So those are really for hardcore programming guys, pretty well, or we'll say highly motivated people. And from my experience, there's the odd person that gets through that. And that's why I have that. That can be done. If you do it, you can do very, 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 very well. with that methodology. Now, that's why I have the other service, the one with the PDF. That is my quant analytics. That's more geared towards people that aren't so strong in programming. So with that service, it'll be fairly cheap. So you can get access to all the charts that I've shown, plus the data, and you can go through that yourself. So you'll be able to generate from the data other trading signals. So that's why I'm building that. And that'll be pretty affordable. It'll be like $100 a month and maybe $200 a month, or depending upon what the market bears. So Mike says he just signed up for the email list as well. So if you are interested, I'm going to repeat for anybody out there watching this or watching this now, there's two areas I have. I have an analytics service I just mentioned for non-programmers, people that want to get access to the type of charts I've shown tonight. Also the data itself, and it's processed data through my scripts that I've developed, and that's a monthly service. I'm going to have a chat room out of that. I'm going to have all kinds of new stuff that I haven't announced yet. And that is through this download PDF option, this one right here, free book reveals. Okay, so that is the analytics service, and you get on that email list. Then if you want the programming stuff, you come under the courses. So two separate services that I'll offer. But if you're not so strong in programming, go with the PDF one. But if you want to take the challenge, own the code, control the code, go with the courses. Now, in terms of can I do and have the code built for people, I can't get into that line of work for a number of reasons. I mean, I'd be probably able to charge a lot of money for it. I don't know what the market, again, can bear. But I have people that I know on my Facebook. Oh, how long did it take you to master the craft? Let me put it this way, Kev. I don't want to scare you. I've been doing this for 9 years, let's say. From average, what I've been told from highly skilled banking folks, it took up to 8 years to get to this level on the programming front. And I'm nowhere close on the math side of being what they call a real quant. But that's the average. For me to really get to where I'm at, once I understood the technical analysis, what I showed, it took not very long. If you're strong in Python and understand the technicals and the real indicators I've shown tonight, it wouldn't take very long, a couple of months. The determinant that will drive you to be successful is to have just that, the drive. The inner drive is the key. There's a lot of black box technology out there. It just doesn't work and it fails. And you can see in some of the charts, black boxes may work for certain market conditions, but when the markets turn, the black box is no good. So to overall get the skill level, it can take, depending upon your knowledge of programming and your knowledge in trading, it could take a couple of months all the way up to a good couple of years. I just don't know you. I don't know your level. But at the end of the day, what will get you there is your drive. There's no real easy fix. That's pretty well that. Hopefully answer that question. Anybody else got any questions, comments? So as I said, next week, I do these Monday nights at 7 p.m. Eastern Standard Time. The next one will be next week, and that will be for the patterns. The patterns is really key. I've known about patterns, but once I started and seeing how to implement them, that will be your savior on the bad signaling. We'll talk about that next week. So if you got any questions or comments, don't be shy. This is the time to do it. And then the following week, in the first Monday of May, I'll be doing a one-on-one social for the Toronto crowd at a restaurant for some events. And apparently a big broker just approached me today wanting to do some stuff, but I'm a little, well, let's just say I'm not sure if that'll happen or not because I'm too honest. I'll leave it at that. Anybody else got any questions or comments, concerns? I appreciate all the likes so far. I love doing this stuff. I'll be, just so everybody knows, what's going to be happening is in the next week or so, I'll start starting up my, okay, what should you expect more info about learning about the programming courses on the email list? Okay, Mike, what will happen tomorrow in the next few days is I'll be sending out the details of the upcoming live boot camps I'll do on the Saturdays. That's number one. Number two, I'll be introducing the courses and the new Forex course for Dukascopy. So I'll be doing that over the next couple of weeks. That's to hype that service. That's the idea there, to get people roped into that service if that's what they want to do. And that's why I'm trying to get people onto that email list. Kev asks, should traders bother touching Bitcoin anymore? Absolutely. I think cryptocurrency is still hot. The problem is, let me show you CoinMarketCap. This is a good question from Kev. Okay. Hopefully I've answered your question, Mike. If you got any more questions, don't be shy. Okay, so here's the CoinMarketCap. And the cool thing about it is if you go under market cap, trading volume by exchange, okay. I'm not sure if you guys have seen the Python package I kind of high level introduced called, what's it called? CCXT. I'll show you. CCXT, it's on GitHub, it's free, it's Python. I've been talking about this puppy for a long time. I love this thing. So in here, you got CCXT, you have the Python, and you have a Python option, which I would strongly recommend. And you can talk to any of the big exchanges for crypto. Thanks for your sincerity, but it was a terrible, no, it's not a terrible question, Kev. Let's go back to market cap. This is why I love cryptocurrency. Were you going to make money? You want to make serious money? Let's check out the 24-hour percent changes. So if you look at just alone on Bitcoin, this is a 20% daily volume change for Bitcoin. On Bitfinex, it's 9.98%. OKEX, 5.32. I know nothing about these exchanges, but I'm just from a high level. If you want to make serious money in crypto, be it Bitcoin, look at this volume change on Tether, 15%. So if you put $1 in on that Tether, you'd be up 15 cents within 24 hours. No other asset class gives you this. This is absolutely money making. It's a printing machine if you get it right. So that's what I love about cryptocurrency. Would I recommend beginners getting in? No, absolutely not. But if you get a strategy that can kind of work and be able to measure on price alone and only price, and be able to measure that volume and the direction of that volume, you'll do very well. And you could build up wealth very quickly if you consistently get that right call and the right currency or coin, as well as the correct exchange. That is if you're on the upside all the time. But here's a challenge: is what's the likelihood of that? Pretty low. I hate to say it. Again, but if you have a working strategy that can work, yes, you can do very well with cryptocurrencies, very well, very quickly, no matter what happens, no matter what the price is with crypto, because alone of volatility. And that's how you make money in the world of Forex, is off of volatility. And then you add in the leverage. I mean, it's high risk. Remember, it's always high risk. But if you get it right, you can do really well. And there's lots of people doing that. What am I inspired into diving deeper? That's a good question, Kev. I'm going to be honest. Right now, I've talked about Forex and how the performance of Forex has been not good. And I got confirmation of that last week, that a lot of the currency traders are not putting a lot of capital into Forex because of the performance and the high risk from the trading wars driven by Trump. And as a result, currencies are much high risk. Now, if you ask me the world of cryptocurrencies where I'd like to put more money into here, but it's a challenge. And if I can find a working strategy, I'd definitely be on top of that. And that's what I'd focus on. And from a marketing perspective, this is where the market's going to be and want to be, is in the world of Bitcoin. So who or what inspired you to dive deeper, books or works? I guess you're looking for kind of references on what I have that works for me. I just got an email from good old Dr. Ernie Chan, as I call him, Doctor in the House, from Niagara Falls on the lake here in Ontario. He's really good. If you want, and you don't know him, you got to check him out. And I'll be seeing him fairly soon, but his stuff is awesome. He's a super honest guy. And if you don't know him, look him up, Dr. Ernie Chan. He runs a hedge fund. He's going to be one of the lead talkers at the Quantopian QuantCon coming up. Apparently, he's going to be working with one of the big brokers, and he's got 3 books out. So let me see if I can find his books. So he's gotten into machine learning. He is a true quant. He's a PhD in math, I believe. He's a hedge fund guy. He runs his own hedge fund, so he's got skin in the game, and he's a good guy. So let me see on his books. So he's got his 3 books here on Amazon. So yeah, just Google Dr. Ernie Chan, epchan.blogspot.ca, as you can see here. And here's his 3 books. The book that started me, Kev, was this one right here, Quantitative Trading, the very first one. And these 2 other ones are really good as well, with the machine learning specific. Just from a high level of somebody who's driven in the industry, this is your guy to learn. And he's got all 3 books. My next big challenge is to start learning machine trading, machine learning is the next big area I want to get into. But I'm putting that on the ice for now, because I just want to get all this stuff that I've got implemented and running and trading and show that to the world. And hopefully I'll answer your question. But this is a good guy to learn from, with a PhD as well as a true quant guy. Quantopian goes to him for his stuff, and I think Quant Insti is another one as well. He's recognized. He's probably the most prolific out there and the most respected that I've seen. And he's a good guy, really personable and really cool to work with. And he's got 3 books. I think they'll cover a lot of stuff. So I've been blabbing for almost 2.5 hours, which, like I said, I don't mind doing. Who else got questions, comments? How many people got? 3 and 3. People are dropping off now. That's fine. Anybody else out there? What I usually do. So next week, I'll be doing my usual, what do we call the patterns, and they work. The question is patterns versus machine learning. Patterns are simple and easy to implement. My patterns are no more than 150 lines of code, and it works well compared to machine learning. I think you get better performance on the patterns. Kev says, have a good evening, Brian. Have a good evening, Kev. Thanks for all the awesome questions and for being part of this. I appreciate it. Hopefully you got some stuff out of it. Appreciate all the kind words, and I'm not sure if you gave a like, but really appreciate it. Yeah, so that's next week. We're going to talk about patterns. Eventually, I'm going to do a comparison between things like that and machine learning. And you want to work with a simpler and better performing stuff. And that's what I plan to do. So anybody else got any questions, comments, criticisms at all? If not, we'll be doing this again next Monday at 7 p.m. Hopefully you're on my email list. If you want to get some of the better learning as well, talk about what I'm planning to do on the promotion side. So let me know. Anybody? I'll do going once, twice, 3 times. And if not, we'll just wrap her up and I appreciate it. If we don't hear from you over the next 3 seconds, don't be shy. There's no right or wrong here. So I'm going to do a going once 3 times now, and I'll be the final wrap for tonight if I don't hear before that or the end of that. So I'm going to do a going once, a going twice, going 3 times. All right, so we are out of it all. I guess we're done. Okay, folks, I appreciate you being part of this. Close down the YouTube stream, and we shall have the playback up in no time on the YouTube channel at Quant Labs. And again, if you're interested in continuing the conversation, let's come to quantlabs.net/blog and choose either download PDF option of courses, get on the email list, and my system will dispatch a fresh new bunch of emails and let you know what's going on. All right, so we shall talk to you soon. Hopefully I'll see you on Monday evening, and have a good night all. Thank you once again. See ya.